companies have been taking advantage of and contributing to FASB's inadequate rules regarding stock options. In particular, the lack of having to expense them on the income statement and the lack of having to report them as a liability on the balance sheet. My question is, are either one of you doing anything to help FASB's current stance on the issue? If not, have either one of you ever considered establishing a, quote, real, end quote, independent body of accountants that would actually try to make companies produce accounting statements that reflect economic reality?
Charlie, I'll let you get the history on it.
Well, we don't like the accounting, which we've called corrupt, or at least I have. And I don't think that's too strong a word. I think it's corrupt to have false accounting because you like a certain outcome better than another. All that said, I don't think either of us spends a lot of time fighting with FASB or trying to create a better one. It's like splintering your lance against stone or something. You'd get a lot of back pressure from the butt of the lance, and we can't be expected to cure all the ills of the world.
We've written about it and talked about it. Obviously, you've picked up on it, and when it was an active issue, whenever it was, about, I don't know, 4 years ago or so, Senator Levin of Michigan was one of those who felt as we did. And of course, FASB felt as we did. But the pressure was incredible that American business brought on Congress. They weren't getting, they tried to put pressure on FASB and they weren't getting a result, so they just said, well, we're not going to let FASB set the accounting rules, we'll have Congress set the accounting rules. And I thought that was a bad idea per se, but I thought in this, but they got plenty of supporters. Got a huge number of supporters. I mean, and at the time I compared it, I think there was a bill introduced in the Indiana legislature in the 1890s, I believe, and the bill was to change the value of the mathematical term pi to 3 even instead of 3.1415. And the legislator who introduced it said that it was too difficult for the school children of Indiana to work with this terribly long, unending term, and it would be so much easier if pi was just 3, and he thought that they ought to enact that. Well, I thought that was quite rational compared to what the Congress of the United States was going to do, in telling people that since one of the arguments was that it makes it very tough for startup companies if they have to expense this. Well, it makes it tough if they have to pay their electricity bill too. But I mean, but those were the kind of arguments you got. And my memory is, Charlie is better on this than I am probably, but I think the accounting firms 40 years ago or 50 years ago were in accord with our position. But every client would put pressure on, and they don't want to report expenses. They particularly don't want to report expenses that are paid to them, and that can be huge, and that might prove obnoxious if recorded by conventional accounting, but if it's sort of lost in a table in the proxy statement, people don't pay much attention. So the only way it will get changed, we wrote about it, and I even talked to a few senators at the time. The only way it'll get changed is, and this is the only way corporate governance problems generally will get changed, if 15 or 20 large institutional investors would band together in some way on this. But some of them have the same problem because they're getting paid extraordinary sums for doing something that is really not adding that much value. So they're not really inclined to call attention in many cases to what Charlie would refer to as obscenities in other people's compensation. So I think it's going to go on. I mean, it's a fascinating subject, but the institutional investors seem to focus very much on matters of form and not substance. I mean, you get a lot of, they cluck a lot about little things that don't have anything to do with their economic return over time, whereas on stock options there's something that's terribly important. They're the ones that are paying the costs, and the costs are there whether they get recorded or not. But American management will not change its position on that voluntarily. Consultants will never change their position. They're getting paid to encourage people to look at other companies, and it just keeps ratcheting up. So I don't think you're going to see change unless institutional investors do it. And as I say, I get these questionnaires, about the composition of the board or a nominating committee. None of that makes any difference in terms of how a business performs. Got one form. It said they wanted a list of directors broken down by sex, and I said none that I know of. But it just is not germane. Charlie?
Yeah, right. Well, I can't top that one.
Gillette, do you think their goal of trying to grow earnings at 15+% kind of got them into their current inventory problems at the trade? And as well, the Duracell acquisition, I know at the time neither one of you were the biggest fans of the deal. I just want to know how you feel about it now.
Well, I would say it's a mistake, and I've said it. I think it's a mistake for any company to predict 15% a year growth. There are plenty of them do. For one thing, unless the U.S. economy grows at 15% a year, eventually any 15% number catches up with you. It doesn't make sense. Very, very few large companies can compound their earnings at 15%. It isn't going to happen. You can look at the Fortune 500, and if you want to pick 10 names on there that will compound their growth from other than some extraordinarily depressed year. I mean, if they had a year where they just broke even, so the number is practically zero. But if you pick any company on there that currently has record earnings, and you want to pick out 10 of them that over the next 20 years will average 15% or greater, I will bet you that more than half of your list will not make it. So I think it's a mistake, and as I said in the annual report, I think it leads people to stretch on accounting. I think it tends to make them change trade practices, and I'm not singling out Gillette in the least, but I can tell you that if you look at the companies that have done it, you will find plenty of examples of people that have made those sort of mistakes. And I think that in connection with Duracell, I mean, obviously Duracell has not turned out the way that the management of Gillette at the time hoped that it was going to do, and who the investment bankers who came in and made the presentations, those presentations would look pretty silly now. Charlie?
I think that kind of stuff happens all the time. It will continue to happen. It's just built into the system. I see more predictions of future earnings growth at a high rate, not less. I mean, a few people have sort of taken an abstinence pledge, but it's very few. It's what the analysts want to hear.
That's what the investor relations departments want the managements to say. It makes their life easier, but they don't have to be there 5 years from now or 10 years from now doing the same thing. If we predicted 15% from Berkshire, 15% means that, assuming the same multiples, I mean, that means, in 5 years, 200 billion, in 10 years, 400 billion, 15 years, 800 billion, $1.6 trillion in 20 years, and the values get to be crazy. And, if you have a business with a market value of 400 or 500 billion, and you've had a few of those not so long ago, just think of what it takes to deliver in the way of future cash at a 15% discount rate to justify that. If you've got a business that's delivering you no cash today and it's selling for $500 billion, to give you 15% on your money, it would have to be giving you $75 billion this year. But if it doesn't give you $75 billion this year, it has to be giving you $86.25 billion next year. And if it doesn't do it next year, it has to be giving you almost $100 billion in the third year. Those numbers are staggering. I mean, the implications involved in certain market valuations really, belong in Gulliver's Travels or something. But people take them very seriously. I mean, people were valuing businesses at $500 billion a year or a year and a half ago, and there's just no mathematical, almost no mathematical calculation you can make that would, if you demanded something like 15% on your money, there's almost no mathematical calculation you could make that could possibly lead you to justify those valuations. Charlie, have any more?
Well, I said on another occasion that to some extent stocks sell like Rembrandts. They don't sell based on the value that people are going to get from looking at the picture. They sell based on the fact that Rembrandts have gone up in value in the past. And when you get that kind of valuation into stocks, some crazy things can happen. Bonds are way more rational because nobody can believe that a bond paying a fixed rate of modest interest can go to the sky. But with stocks, they behave partly like Rembrandts. And I said, suppose you filled every pension fund in America with nothing but Rembrandts. And of course, Rembrandts would keep going up and up as people bought more and more Rembrandts or pieces of Rembrandts at higher and higher prices. I said, wouldn't that create a hell of a mess after 20 years of buying Rembrandts? And to the extent that stock prices generally become sort of irrational, isn't it sort of like filling half the pension funds with Rembrandts? I think those are good questions.
Once it gets going, though, people have an enormous interest in pushing Rembrandts. I mean, it creates its own constituency.